interested in and you want a little bit of a conversation going as to is it the right option strategy, give us a call. Again, bullish, bearish, neutral, doesn't matter to us. Give us a call, of course, 877-927-6648. Plenty to talk about, obviously, today, but, hey, we'd love for you to call in. This is the call-in show. So with that, I've been chatting back and forth with a couple of the guys over in the Tiger Den here today. I'll go through the market here and just give you guys a quick rundown in a minute, but obviously, I take some positions here, and I've talked about them over the last couple of weeks. I've got long positions in things like TBT, which has been absolutely crushed down. I'm short gold, which is finally turning around a little bit today. And, wow, I'm taking some heat here in the Tiger Den today, which is good. Hey, don't worry, guys. I got them exactly where I want them. And, ultimately, I'm pretty comfortable with my position. Wasn't too comfortable last night when I looked at the futures that were down 33, but, it was kind of a... a little bit of a brutal open today, but we've cut our losses in half on the day. So let's give you guys a quick rundown of the market and then talk about some of the specific positions. Take a couple callers. Of course, the number is 877-927-6648. S&P futures down 1750. NASDAQ futures down 2850. Dow futures down 181. The VIX is up. VIX is up actually $4.17 right now. Bonds way off the highs of the day, are actually up only about 19 ticks. In fact, the 10-year, the ZB is what I was quoting there. It's up about 20 ticks right now. The 10-year is actually slightly down now on the day. Gold is off $5.70. Has also been kind of the talk of the chat room in here today. In fact, for those of you that haven't seen gold, again, quite the rally from last night this morning, and just a market sell-off here in the last approximately hour. Gold has slid considerably. Anyway, with that, all right. So we're currently awaiting calls right now. So feel free to give us a call, 877-927-6648. Waiting a calls. Anyway, with that, so TBT is now still down on the day. Again, as I was saying, the market has had quite the big reversal when it comes to bonds, gold. Surprisingly, the VIX is held up pretty strong today. The VIX has actually had a high of 39.86. You got to realize that's a lot of premium, a lot of juice to be selling out there in terms of options. When you look at recent years, the average of volatility hasn't even been at 20. When I say recent years, in the last 5 to 10 trading years, the average has been closer to about 17 in the VIX, and you're seeing a VIX right now trading up and around 40 and holding pretty strong up there. There's a lot of premium to be sold right now, and that can be that's wide open. When I say selling premium, you can go out there, sell puts, sell iron condors, sell vertical spreads, whatever strategy you're ultimately comfortable with. I'm going to answer a couple of questions as we go through. There's some things going on in the chat rooms as usual, and I'm kind of reading through here. So feel free to chat in questions, of course, to the Tiger Den. Also, of course, give us a call, 877-927-6648. We'll kind of jump into it. As you guys know, I am very much an index trader. I have obviously taken some positions in a few commodities such as gold lately, but gold has been, the interesting kind of talk of the town here lately. But ultimately, I'm a big-time index trader, and that basically entails, I talk a lot about S&P 500, NASDAQ, which could be the Qs. I do cover a little bit about the Dow from time to time. To be honest, I don't trade the diamonds all that much anymore, and it's just it's not necessarily a liquidity issue. The diamonds actually have got great liquidity. It's ultimately, what products I'm comfortable with here, and of course, lately I've been talking a considerable amount about GLD and of course TBT, and one of my largest positions right now is in TBT. And I'm on the wrong side of that position. For those of you that have listened over the last couple of weeks, that is, I am long TBT. I am short gold. It makes for interesting conversation, but not interesting net liquidity of my account. Anyway, with that, we'll jump to a caller. And before we do this, you should give us a call, 877-927-6648. We're going to jump to Gary in Colorado Springs. Got a question about TBT. Are you there, Gary?
I am. How are you doing, Don?
Good. I'm kind of hanging in there. You have to bring up TBT right off the bat, huh?
I'm actually thinking about going long TBT, so I'm not here to bash you.
No, not at all. You know what? And when people are in the chat rooms and stuff, they're like, hey, you're long TBT, you're getting killed. I usually, when everybody's jumping on that bandwagon, I know I'm in a good position. It's when everybody's like, wow, this was the greatest call of all time. I know then I'm screwed, but listen, I've been a contrarian in trading since I started trading, so I'm used to it. My most uncomfortable days, like this morning was pretty uncomfortable, is usually a sign of the turn. It's funny because I'm looking at my position this morning, and I'm in West Coast time right now. I'm in Scottsdale, and I'm up this morning at like 5:30, looking at the futures, recognizing where TBT was going to open, and I'm like, this just sucks. So at the open, I just started going out and buying more shares.
There you go.
Because
I was looking at that September 23-22 vertical on the put side.
Yeah. So
selling it.
Do you want to own shares, or you just want to basically take a directional position in here?
Directional.
All right, so purely directional. Well, September, they only got 10 days left till expiration. You're comfortable with that? You're looking for a short-term bounce?
Yes.
Okay, so that would totally work. There's another, so you could sell. You're looking at the selling 23s, buying 22s?
Right, for 55, 56 cents.
All right, so, there's nothing wrong with that. I mean, max profitability, 55 cents. No, there's nothing wrong with that at all. Obviously, the 23s are slightly in the money, so if this thing dips down anymore, you gotta be obviously careful of the short 23 puts. It's not like this thing is going to be put to you early, but it could happen. It's not deep enough in the money right now, but the risk reward of this is pretty straightforward. I mean, for the most part, you're in the neighborhood of risking 50 cents to be able to make 50 cents with about 10 days to go. But if you get any kind of a bounce, as long as we get over 23, and this underlying for a $22 underlying, like people don't realize, this thing is moving. I mean, the volatility now of TBT is sitting, if you look at September, at 63%, which obviously that's double the bonds. The bonds at a 30% volatility is absolutely unheard of. I mean, 30% vol in bonds is extraordinarily high, so it's something to consider. So, I got no problem with that strategy whatsoever. The inverse of exactly what you did is going out and buying, for instance, the 22-23 spread. It's almost the exact same thing, just buying the spread instead of selling the spread. But I like it. And if you want a little bit of a longer trade, you can look out to October.
Okay. Well, appreciate your input.
All right. Thanks a lot. Thanks for giving us a call about TBT.
Thanks.
All right. So with TBT in mind, we'll talk a little bit about it, and then I'll jump back because I saw a few questions come up in the chat, and I'll definitely address them here. Anyway, with that, let's talk a little bit more about TBT because it's on my mind. Anyway, this morning TBT opened, and it was right around the range of 22.10 or so. So in all seriousness, I was so uncomfortable with my position this morning, that I actually went out and bought a little bit more. And people are like, why would you do that? I'm still well within my comfort level of the number of deltas that I'm taking in something like TBT. And when I say that I'm more than comfortable with the number of deltas, what I'm basically saying is everything in my mind equates to delta. And delta, if you say 1,000 TBT deltas, what that means is you're ensuing the equivalent risk of 1,000 shares of TBT. And I come up with a number that I am comfortable with, meaning like, and by the way, everybody's number is a little bit different. You can say, hey, 500 shares of TBT might scare you, or 5,000 shares of TBT might scare you. But I am well within my comfort level still on TBT, and I decided, this morning, hey, I'm looking for a little bit of a bounce here in the next couple of days. So I went out and loaded up a couple of more deltas. And in this case, I actually utilized the shares, the physical shares of the TBT. And listen, these trades are not necessarily right for everybody. I don't like to hop on, a show like this and say that, you should definitely go out and buy shares. I mean, this is a double inverse ETF. You got to realize that something like TBT, it has a decay rate associated with the physical stock. Forget about options for a second. There's a decay rate associated with the physical stock TBT, and that is whenever you have a double or triple inverse ETF, they are charging you the cost of carry associated okay, and a management fee associated with carrying this particular underlying, because instead of functioning like a $22 underlying, it's functioning, okay, as almost the double inverse of the TLT. And obviously, how are these double inverse created? Well, most of the time they utilize futures products. Okay, so again, there's a cost carry associated with holding any one of these underlyings. And if you guys read, like, the FINRA standards or SEC standards, they basically say these things are not fit for holding more than a day. Now, that's, again, I've traded a little bit. I'm more than comfortable holding an underlying like this. But ultimately, again, to me, it's all about my comfort level. Hey, I'm willing to be long X amount of shares of TBT. And again, I equate that to deltas in my head. So you have to realize at some point when you look at bonds, and there was an interesting point I was trying to make to a colleague of mine earlier today. So one of my colleagues was looking, and he said, "You're absolutely out of your mind." He goes, "Interest rates are going to stay low for quite a long time." And I said, I totally agree with that. So interest rates could stay low for a long period of time. That doesn't mean, all right, that bonds won't sell off. All right, we're looking at 30-year bonds at 3.2-something% right now. You're looking at a 10-year at 2%. It's sooner or later someone will realize that tying up capital in one of these bonds is ridiculous for a 2% return. And then you start to realize who's tying up the capital for these 2% returns. So outside of, obviously, sovereign wealth funds, federal governments, China, for instance, the United States, you have to start to look at some of the investors in these. Some of the investors are trading other individuals' capital out there, and were you willing to pay a money manager to go out there and to buy you a 10-year and make you 2%? I mean, it's just ridiculously low numbers. So ultimately, sooner or later, somebody realizes that, hey, we might be able to generate better than a 2% return, okay, that we're doing in this 10-year note right now. Maybe we should go back into the S&P 500, and that's just a cyclical thing that it'll happen over time. I mean, there's no question about it. And ultimately, when you start to look at things like, rates at these levels, rates trade like commodities. And that's something that I was trying to make clear, in the last couple of weeks. So I say that rates trade like commodities. What does that really mean? If you looked at a barrel of oil right now, and you saw a barrel of oil, all right, at, let's say, $20 a barrel, something ridiculously low, at $20 a barrel for oil, it just doesn't even pay anymore to pull that oil out of the ground. Okay, so what basically happens when it doesn't pay to even pull the barrel of oil out of the ground at $20 a barrel, 20 is oil zero, meaning that when the oil would hit $20 a barrel, that's like oil trading zero. If you look at the bonds right now, they're basically trading the effective of zero. They've rallied so far. Interest rates can only come down so much. And sooner or later, it's like, at 3.2% for a 30-year bond, that's like trading zero. Now, a lot of us have been looking at this trade for a long period of time, no doubt. I'm, underwater and underwater big on the short bond trade. And I'm comfortable, talking about being short bonds, no question about it. Sooner or later, these things turn around. And it's not often that markets present bubbles such as the one that we see here in something like these bonds. Okay, and when I say it's not often, I mean there's once in a lifetime opportunities out there. The problem with this one is it's pretty transparent, and every professional trader seems to have jumped on this particular bandwagon. So it's what I call a crowded trade, and when they're crowded trades, they take longer to work. No question about that whatsoever. Anyway, give us a call. You have a tendency to get me on rants over here, but give me a call, 877-927-6648, because this is a call-in show, and it's just not any fun if you guys don't call in. I'm actually also going to address a question that came up, comment that came up in the Tiger Den. It says, Don, I don't trade options on equities because the spreads are too wide. There are too few options with nickel-wide spreads. So, Mike, I actually kind of reading your question in here, and I agree that certain underlyings still trade with relatively wide markets. One of the keys to trading options, and to be effective trading options, is to obviously trade underlyings that have got massive liquidity and super tight markets. And when I say massive liquidity, I mean right now. So I happen to have the TBT on my screen. They're penny-wide markets. All right, so if you take a look at the markets on here, we've got about 10 different exchanges that are currently quoting markets here, for instance, in TBT. And there's no differential in the bid-offer spread. I mean, it's 61 cents by 62 cents. It doesn't get any tighter than that. The reality is this. When you go out and you find a stock called Joe's Tree Cutting Service and it has 10 and 15 cent wide markets, it's insane. I wouldn't even consider trading it. Every single day people call into shows like this and they say, hey, I want to trade some stock like, again, Joe's Tree Cutting Service. And you look at the options on there, and somebody would still go through and give you like an option trade. I just won't do it. I mean, I'll hop on an underlying. If you guys ever call in right now and you say, hey, I'm thinking about, this stock, XYZ, I don't care. One of the first things I look at is the bid-offer spread differential, and then I look at open interest, look at the volume there, and if it doesn't satisfy, some kind of minimum requirement, then I don't even consider it for a trade. People go, but I have a really good feeling this stock is going to go up, or I have a really good feeling this stock is going to go down. It just doesn't matter. At that point, hey, if you want to trade the stock, trade the stock. But options are about liquidity, and you have to realize that there are people on the other side of the trades. Don't give them an extra penny, not even an extra penny, much less 5 cents. I mean, the reality, in my own trading, I don't even trade that often things that trade in 5-cent wide increments. One thing I want to be clear, if you look at like Apple, there's something interesting. I love to show people about something like Apple. So Apple is a $374 underlying. And again, I'm kind of displaying this on my screen right now, $374 underlying. And the September options, there's 10 days to go to expiration. September options are trading with a 10-cent wide market. So right now they're 5-cent wide. So it's $5.95 at $6. And you're like, oh, man, it's like a 5-cent wide market. That's on an individual option if they're 5 and 10 cent wide. Now I'm going to show you something kind of interesting. If you look at the individual option, they trade, the individual options trade 5 cents or 10 cents wide bid-offer spreads. But if you look at a vertical spread or a calendar spread or any complex option trade, now a complex option trade is denoted as an option trade that has more than one leg. If you look at any complex spread, they trade in penny increments. So think about that for a second. The industry is telling you something, and a lot of clients don't pick up on this. What am I saying? The industry is telling you something by saying, listen, we're going to completely screw you if you trade an individual option. If you go out there and just buy a call or buy a put or sell a call or sell a put, the bid-offer spreads are relatively wide. But if you trade spreads, spreads, that is literally a complex spread with just more than one leg, all right, they're giving you penny-wide markets out there. So it's something for all of us to think about because a lot of clients don't catch on to that traders on the other side of your position are willing to do spreads at better prices than individual options. And there's a risk premium reason for that. And if you guys want, you can shoot in here to the chat room, and maybe I'll go into that in a little bit more detail, though, of why they give you better markets and spreads than they do individual options. Anyway, with that, hey, it's a quiet Tuesday morning here on the call-in show, so please give us a call, 877-927-6648. And again, you guys can call us with anything, whether you got a stock question, an option question, a futures question, you name it, give us a call. We'll try to answer it for you the best we possibly can here. And, hey, if you're thinking about getting long, short, or neutral in any specific underlying, we'll even talk about the liquidity of your underlyings. Again, I got no problem whatsoever saying, like, hey, the liquidity of this is not great enough. One thing people always chat in, they say, hey, what is the minimum liquidity in terms of options to be you make them worthwhile to trade? And the answer is this. If you have to ask about liquidity, it's probably not liquid enough. And I know that sounds kind of like, this catch-22 I'm giving you here, though. When you have to ask about liquidity, it's just, seriously, it's probably not liquid enough because everything that's liquid, for the most part, penny increment options, you don't limit yourself to just penny increment options, but everything that's liquid are underlyings that everybody's trading on a day-to-day basis out there. So, all right. And, let's jump to a couple of questions here in the chat as we're going along. I am kind of trying to read and talk at the same time. But, again, if you guys want, rather than chatting, you can give us a call, 877-927-6648, and we would be happy to answer your questions live. G7 was actually commenting here on Pandora. So I saw the comment here on Pandora, and I just want to make a quick comment about that. Forget about the underlying stock. Forget about anything. For those of you that listen to Pandora, and I've got my iPhone and I listen to quite a bit of Pandora sometimes when I'm sitting here answering emails throughout the day. Sometimes I work out, I listen to Pandora. All of a sudden, one day they become public. The next day, the number of commercials has gone through the roof. I don't know if anybody else has noticed that yet, but it used to be once every 5, maybe 10 songs. But Pandora is advertising, and they have cranked up the algorithm that not only knows exactly where I am, but it also knows to give me more commercials wherever I am. So I was curious if you guys chat in or give us a call if you guys found that to be true for those of you that do listen to Pandora. G7 also had a question about a specific ETF. So, hey, G7, me and you are just going to have a chat here throughout the day because there's not a lot of callers here today. I know some of you guys work for a living. You work for a living, but you're in the chat room listening to the show, but you can't call in. Anyway, with that, you guys should give us a call, 877-927-6648. So he had mentioned EWG, which is the iShares Germany. The reality is there are so many illiquid ETFs out there right now. When people look at the German iShares, and there's literally an iShares for almost every single country out there. Sovereign wealth funds are even having ETFs listed on them right now. So let's take a look at the volume and open interest, and it's nominal in here, meaning that the volume, the open interest of the German iShares is not massive, and the markets are about 15 cents wide. You can see that when I say a volume and open interest, I'm actually looking at the number of contracts open, the number of contracts traded today. Even looking at the October options, I mean, some of the heavier strikes have 200, maybe 300 contracts open here. This is like one of the underlyings where I have no problem saying it's probably not worth our while trying to create an option trade in here. So you'll notice that the options trade in 5-cent increments. Let's take a look at the spreads. So the spreads themselves trade in penny increments. So it's interesting, again, when you look at this, you have a marketplace on the individual options that are 15 cents wide. So we're looking at a market right now in October that's $1 by $1.15. Now, if you trade this, you've got to give up a lot of edge. You might be able to buy this option for $1.10. You might be able to sell this option for $1.05. But the reality is you're still giving up considerable edge in here. Whereas if you trade the defined risk spread, whether you're buying a spread or selling that spread, you trade the defined risk spread, you can literally go after penny increments and probably achieve a much cleaner, much better fill. So for those of you that have this belief that you can't trade anything that looks a little bit illiquid, well, you can't trade the individual options, but you could look towards certain defined risk spreads out there. All right. Anyway, I love some of the comments coming in here. Is the increase in advertising on Pandora is the reason I stopped using it. Listen, if you guys know another service outside of Pandora, by all means tell me, because it's kind of funny is there's a few people that work at the ThinkorSwim from TD Ameritrade group, and we don't work in the office every single day. I literally work out of my home office. I travel around quite a bit. So traveling, I'm listening to Pandora. Sitting in my home office, I'm listening to Pandora. My baby listens to Pandora right now. If you guys know of another service, by all means, let us know with a little bit of less advertising. Once again, going public is not always the best thing for a firm. So I'm glad you guys actually agree that they cranked up the advertising there in Pandora, because I thought I was completely nuts. Anyway, listen to local radio stations. That's what the guys at TFNN said. So local radio stations, man, they're going to have a bunch of gold commercials on right now. So I had to take my shot at gold there once in a while. It's funny, I'm in a short gold position right now, and my decision for getting short gold is largely based upon the fact that every single radio station I turn on is advertising something for gold. And the TFNN included there, so every single station I'm talking about is literally you get in your car and there's something talking about gold. So we're actually going to jump over to gold, and we're going to create a short gold position here. In fact, what I'm going to do is hop into GLD. For those of you that haven't seen the I'll pull up a chart on GLD if you guys are watching the screen show right now on Tiger TV. But let's actually pull up a 1-day, 1-minute chart in here as well. And if you look at the one-day, one-minute chart, it has been a wild ride all the way from 185.50, or you almost touched all the way to 186 in GLD, all the way down to 182.50. So GLD has been just absolutely ripping all over the place today. But ultimately, again, when you look at a commodity, one of the first things I look at in some of the commodities, such as gold, is I'm taking a look at the implied volatility, and the implied volatility is 33%. It's relatively high out there. So I like, there's a lot of people commenting already in the chat rooms here, Don, don't be short gold. Why? I like it. I like taking the other side of the position, the other side of the world. It, again, when I turn on the news, when I turn on local stations and everything is about gold, again, that is, for me, the contrarian reasons why I want to get into the position. And you guys can look at every fundamental reason out there. It doesn't matter. To a trader like me, I don't necessarily look at those things. I purely will look at things like a parabolic up move and have to realize that when you look at a chart in something like GLD right now, and I'm going to kind of make an argument that I would kind of make my contrarian argument here. If you look at this parabolic-looking chart, and when I say parabolic, that just means, ever-increasing upward movement. We've had a move all the way from about 143 all the way to literally to 184 with almost not a downtick. Obviously, we had a bit of a downtick here recently, and the parabolic move continued after our little snafu and sell-off here in the last couple of weeks. The parabolic move continues to the upside, well, all the way back up to 185, literally the all-time high here in GLD. And to me, it's a simple trade in here, and I'm going to give you the reason it's a simple trade. When you look at a parabolic move to the upside like this, and you look at the upside potential versus the downside potential, you have to weigh those odds. Okay? At this point in my mind, there is considerably more downside potential in GLD than there is upside. And from a probability perspective, I'm willing to take that trade, meaning that, hey, I could get long gold, but the upside potential, I mean, what's it going to go? Another $5, another $10, and I'm talking in terms of GLD. So if you look at the physical gold future, that is, gold right now is at $1,879 and change. It's basically at $1,880 right now. Could gold hit 2,000? Yeah, I think gold can hit 2,000. I'm not denying that. Could gold even hit 2,100? Yeah, it could hit 2,100. Okay, but to me, that's about the top. In that neighborhood is somewhere near the top. And if people, if you ultimately believe the world is coming to an end right now, then sure, maybe you want to be long gold. Listen, I traded heavily through 2008. I traded through, 2001, some seriously volatile times, even 98 when long-term capital fell. And this entire market, it doesn't feel anything like that. This is not going to be the end of the world sell-off over here. Sure, there's some capital shifting into gold. Everybody's going to safe havens. The bottom line is every monkey in the world is buying up gold right now. Why? Because they're speculating on it. This is not necessarily being utilized as a safe haven. You got to realize there's more capital right now. There's more capital tied up in GLD. The ETF GLD has got more capital, significantly more capital, than the spiders do. That should be a little bit of a warning right there. And I don't buy it. I heard a Goldman Sachs analyst come out and call gold for $2,500, and I was like literally laughing at the time. And I'm like, I got to take the other side. Why? Because it's Goldman Sachs. You got to take the other side of that. So that's ultimately what a contrarian would look at. So I see a lot more downside potential, and I'm willing to get short. But one thing I want to talk about here, when I do get short something like gold, okay, let's talk about how you get short. So the first rule of thumb is this: unless you have a stomach of steel, or you're kind of insane, I'm not out there shorting necessarily shares. So I want to make that really clear that I'm not, listen, I'm as nuts as the next guy out there as a trader would be, but I'm not willing to get short shares of GLD. In the event the world does come to an end, if you just short the shares, you're in serious, serious trouble over here. So for the most part, when I talk about getting short, I'm getting short in some type of defined risk manner. I'll give you an idea. I may jump out to anywhere in the neighborhood between like a 30 and 40 delta, and I'm out in October right now. We've got 45 days remaining to expiration. Now listen, I've got short positions on in September. I've already got short positions on in October options as well. Well, I'll give you an idea of a trade over here. So if I'm going to get short in the month of October, I'm going to go out to this 40 delta, the 189 calls. I'm going to right-click, drag up to sell, down vertical, or left-click and vertical, selling the 189s, buying the 191s, a $2 wide vertical for like a 65-cent credit. That is one idea for being able, of course, to get short. Okay, so again, this is a $2 wide spread for a 65-cent credit. Does that get you short? Yeah. So don't take the assumption that when I say I'm long TBT, I'm just long shares. Although I am long some shares at TBT. When I talk about short gold, doesn't necessarily mean I'm actually shorting the physical GLD ETF. By the way, the GLD is, to me, is the easiest way for a retail client to get involved in gold. You can trade futures on ThinkorSwim, but man, these futures contracts, they're huge in gold. They're absolutely huge, and it's there's where we get into a little bit of a longer discussion about risk management here, but you got to be careful when looking at a future versus, for instance, GLD. I like the idea here of my defined risk trade. If I'm selling the 189 calls, it makes me the equivalent of being short stock at 189, right? Then why do I buy the 191 calls? Well, I buy them just in case I'm wrong. So it's a $2 wide spread. If the world blows up in my face, the world of gold goes to 200 in the GLD, what do I lose? Well, I lose $2, but I've already collected 65 cents up front. My definitive out-of-pocket risk, $1.35. So you walk away. You're all right. For some reason, when people listen to to chats like this or different radio shows throughout the day that are on TFNN, they're fantastic. But you got to understand that most trading isn't about being right or wrong. Okay, I'm going to tell you right now, the life of this trade here, when I say the life of this trade, between now and the time of expiration, which is 45 days from now, this trade, the maximum profitability is 65 cents. If you don't like the idea of collecting 65 cents, don't do, one contract. One contract, you collect $65. Okay? You do 10 contracts. Now, maximum profitability is what? Obviously $650. And you could obviously scale this to anything you want it to be. The reality is this. This trade, during the life of the trade, in 45 days from now, this trade will be both right and wrong, meaning that direction, okay, of gold, is critical. I mean, this is a short call spread. We hope that gold goes down, but the reality is if gold stays flat, listen, gold right now is at, in the GLD, is at 183 even. Okay, this is at 189, 191. Gold's not only got to go up, it's got to go up in pretty considerable fashion over here to just touch this particular spread. So we're already at all-time highs, and then you take a look at, like, hey, is GLD going to go all the way up to a 189 and change? So you got to get to 189.65 as your break-even point. So if the stock stays flat, what happens? These options expire worthless. You keep 65 cents. The market goes down on gold, you keep your money, right? And if the market goes up, even if the market goes right to 189, listen, if we go right to 189, you're probably going to wet yourself. But, again, you're still going to keep your 65 cents. But the reality is that's what good risk-defined trading does. And the other thing I want to bring up is, so I might go out one day and do this particular spread. I'm fine with this spread. Let's take the spread and we'll analyze duplicate trade. I'll drop it over to the analyze screen. You guys can see a risk profile. But then maybe not do the 189, 191. Let's say the market rallies a little bit and it goes against us. Listen, I'm comfortable doing the 189, 191 short call spread in here. But all of a sudden, I only allocate, X amount of capital that I'm willing to part with. All of a sudden, the market rallies again, and now I'm going to get short let's switch it up a little bit. Let's do the 190, 192. So let's sell now the 190, 192 spread for 60 cents. But if the market rallies, this thing maybe even go for 70 cents. And what I'm trying to actually talk about here is strategically layering on a position. You don't just put all your eggs in the one basket and fire at will. If I was willing to do that, I would have sold gold when this GLD was at 160. I'd have just shorted shares at 160. Oof, that would have hurt. Okay, but that's putting all your eggs in one basket over there, and that phrase is just way overutilized. But ultimately, what I'm saying is, listen, good traders, it's not about being right or wrong. All right, it's more about strategic utilization of your capital. It's about laying the positions out there, and again, whether this trade works or not, I'm telling you right now, it will work sooner or later. Okay, there's no question in my mind that sooner or later, either number one, gold stops rallying, Okay, even if the market stays flat on gold, I'm still going to make money. If the market trickles to the upside here in the next 45 days, I'm going to make money. The only way I'm not going to make money is if the world kind of comes to an end, gold rallies well over 2,000, and then I'm kind of screwed on this particular position. The way I look at it, don't worry about it. I'll get it again next month. I mean, I'll go out and I'll fire this position again the next month. And again, I'm totally comfortable putting on positions, contrarian style positions. Now, I will tell you, once in a while, I get myself into a bigger, more strategic position, and that would be something like on TBT. And I'll talk a little bit about my TBT over here. So I love this. Gold trade is a perfect storm now. Seasonals also against shorts. By the way, the more that people talk it up, hey, you're definitely on the wrong side of this position. Trust me when I say this, it's the more I like it. I like to take the other side again of that marketplace, especially when I utilize, my favorite factor is simply this. When I'm either, running around town, I think I talked about on this show last week, when I'm standing in line for coffee at Starbucks, okay, and I'll never forget this. So I think I told this story last week on the show, but years ago I was trading in Chicago. And I left Chicago, came out to Scottsdale for a weekend. I've always maintained a residence in Scottsdale. And I came out to Scottsdale for a weekend. I'm standing in line for a cup of coffee. And this is, when I first started trading, I started trading in 98. And in 99, early 2000, I can't remember exactly what it was. I believe it was January of 2000, maybe December of 99. It was right around Christmas time of 99, 2000. Anyway, I'm standing in line at a Starbucks, and every monkey in line is talking about some stock. I remember one guy specifically talking about eToys, how it was going to put Toys R Us out of business. Another guy talking about Sun Microsystems. I mean, literally standing in line at Starbucks, it drove me absolutely nuts. So, of course, the Monday after that, I got pretty monstrously short everything in tech. I was, selling Q shares. Because we were trading it, in the pits those days. And I'm thinking to myself, there's some monkey here in line in Starbucks, and they have absolutely no idea what this is based on. I've got to get short. So then I remember in 2005, standing in a Starbucks and looking around, and no joke here, I'm in a Starbucks. It's in 2005. I'm in Scottsdale, which is the epicenter of the real estate boom. And in the one Starbucks, there was 4 different individuals sitting down with a real estate agent with contract in hand. And it made me want to get short real estate. So at the time, I looked everywhere, and the only liquid underlying was IYR. So that was it was real estate, but it was some commercial, some residential. So I don't know if you guys remember that IYR. It's the iShares Dow Jones Industrial Real Estate. The markets in here used to be really, really tight. The volume has definitely dropped off right now because the real estate basically, the bottom fell out. And all of a sudden, in the last, couple of weeks, that's what I feel about with gold. I mean, I'm standing in a Starbucks and, I'm listening to something on my, car radio that's talking about gold. It never stops. Bubbles are just that. And it's, you know what? So it is all about a time frame as well. So I completely agree with that. By the way, we could be both long and short. If somebody in here says that, hey, gold in the next 5 years is going to hit 2,500 or the next 3 years is going to hit 2,500, I'm totally fine with that. I never make calls out that far. I'm looking here in the next couple of months because, my lifespan may not eclipse 5 months from now. And when I say my lifespan, my trading. When I look at trading, listen, I don't even know where the markets are going to be tomorrow, much less next week. But I do know, overbought and oversold when I see it. But, markets can extend themselves for a long time, and they can trade hard against contrarians for a very long time before you're right. And I'm telling you right now, I'm like this TBT trade. If you're short bonds and have been short bonds for months like I have been, it's a painful situation to be in. Nobody likes to hold a big losing trade. Even better, nobody likes to add to a big losing trade, which is not necessarily a good idea for most of you guys listening. You pick a number that you're comfortable, being down. And listen, I don't ever put stops in these things. There's no way. I use defined risk option trades. And to me, I'm in a commodity position here on TBT. I'm in a commodity position on gold. At some point, they can only trade so far, so fast. And I don't ever bail these positions until they work for me. it is what it is. So with that, by the way, that sometimes takes a long time to get paid on positions like that. All right, so this has, on record, probably been one of our quietest shows that we've had yet. So give us a call, 877-927-6648, and we still got plenty of time left. Don't make me beg to call. Quick update on the markets here, and then we'll jump back into some of this. And I'm trying to read, some of the chats over here. I love this. Anyway, by the way, I agree with Dan's comment. All this conviction about gold makes me want to short it. Amen. All right, it's that's kind of what that's what we believe as well. So this is the same exact talk that we had when silver was at those lows, and that's absolutely true. When silver was doing what it did, and then they changed margin requirements, it's the same thing. But the reality is, there's a lot of people looking at this gold trade. It's one of those really, really crowded trades. I love the comment in here. Market can remain irrational longer than you can be solvent. That was true. You know what? When these comments originally came out, so everybody's heard that before. Is the markets can remain irrational longer than you can be solvent. The reality is of that was before that listed options traded with penny-wide increments. So screw that comment. I don't buy it anymore because for the most part I got defined risk option trades, and trust me, with portfolio margin, I am plenty solvent in these particular positions, and I kind of like it. I'm telling you, there is, to me, when I'm in a down position like I am right now, and you're taking some heat in a position, I have found over the years that positions that I really took the most pain in, and I will never forget in 2008. 2008, I was buying S&Ps. I was buying everything by selling puts in the marketplace. That's my idea for getting long. I was out there selling naked puts in the height of October, November, and December of 2008. And you got to realize that this was October, November, and December, and the markets didn't even bottom until I believe it was March 9th was the absolute low. March 9th, that was of obviously 2009. So, in the face of adversity, you're out there, you're selling premium. Stuff works, again, sooner or later, as long as your logic is good. Anyway, with that, quick kind of review of the marketplace. Pretty quiet here in the chat rooms and on the call-in show. The idea of a call-in show has kind of been out the window, but the number, of course, is 877-927-6648. Okay. Anyway, with that, there's some good action back and forth here. Looking over here, of course, at the S&P 500. S&Ps are down 1775, really haven't moved since we started talking. NASDAQ futures down 32. Dow is down 182. Gold, GLD now, gold is actually up $2. GLD is actually off 56 cents. So gold obviously has had, was rallied up, considerably last night. Has sold off in a pretty, wild fashion here today. I don't necessarily think this is the big gold down move. The one thing I've got my eye on is not only have bonds have downticked considerably. Bonds are up over a point this morning, only up 21 ticks right now. The VIX right now is still up $4.11, which is kind of surprising since we've rebounded considerably off our lows. The markets, S&Ps have actually cut their losses in half today. So, I'm definitely still keeping my eye open. Could markets sell right back off? Absolutely. When the VIX stays at this up kind of guarded level, you have to look at that. You have to kind of respect the fact that the S&P 500 volatility index is still up a considerable amount. And at some point, bonds, when there's a lot of fear in the markets, bonds obviously rally. But at some point, that's not going to work anymore because bonds, again, can only go so high as interest rates trade, next to their zero range. So obviously, keep that in perspective here. All right, so maybe a key reversal day in gold today could be. You know what? So I'm not much of a market technician. Again, I have tendency to look a little bit more strategically at the trades I'm in rather than try to pick market direction. Anyway, with that, somebody was asking me earlier to kind of construct a trade here within spiders to obviously have a little bit of a bullish stance in spiders. So I want to kind of want to respect a couple of questions that came in here to the chat rooms here. So for those of you that are interested in being bullish in the spiders, I'll assume that being bullish means, not in the next 10 days, but let's put a October trade together. I'm going to give you almost every possible scenario for getting bullish in these spiders between now and October expiration. Number one thing you can do, one of the easiest things you can do, is if you're bullish in the spiders, but you were considering owning the physical shares, you could go out and you could sell a put. Now, selling a put and selling a put naked has always long been considered a risky trade. So what's the risk? Let's talk about this. If I go out right now and I sold, for example, let's say I sold, we'll pick a nice round number, the 110 puts. The 110 puts give somebody the right to put me stock, obviously, at 110. Right now, the 110 puts are trading for $3.55. So obviously, if I get put the stock, what happens? Well, I get put the stock at 110, but I get a little bit of a discount of $3.55 a share. So it makes my effective purchase price, 106.45. I mean, basically, it gets me long stock at 106.45. So between now and the October expiration, if you wanted to buy, the spiders, obviously selling puts would be an interesting way to be able to do that. And so why would I even consider selling puts right now? Because the VIX is still at historically very, very high levels in comparison to where its average or mean has been. The mean, of course, has been closer to 17 in the last 10 years. The VIX trading all the way up to 38 and change right now. It's a pretty interesting opportunity to be able to go out and sell puts right now. Okay, so that's one example of getting long, but that also gets you long shares. Now, I don't ever advise going out there and selling puts and selling them naked unless you want to get long physical shares there. Okay. All right. So the next trade is rather than just going out there and selling naked puts, you could use a spread. You can go out there, for instance, and sell a 110, 108, vertical spread for a whopping 50 cents. Not a lot of premium to collect in here. The 110, 108 put spread is trading for about 50 cents. It leaves you about $1.50 of risk. Again, in terms of risk-reward, well, the probability of this trade is relatively high. The probability of the trade working is about 75%, okay? But ultimately, the risk in the trade is $1.50 to make a whopping 50 cents. And the reality is if you got a lot of conviction, you're relatively bullish, hey, this trade works over here. So sell the 110, 108 put spread could definitely work. All right, so let's a couple other considerations. So we've gone out and we've sold naked puts. We've sold the put spread. What else could you do? You could buy a slightly in-the-money call spread. Now, this is a little bit different than maybe some of you guys seen us do before. But, for instance, I can go about one strike deep in the money, turn on buy, for instance, 114. Let me play with this for a second, 117 spread. The spread actually works out all right. So a 114, 117 spread for $1.76 debit. This trade is a little bit more aggressive in nature in that the probability of success isn't nearly as high as selling a put. The probability of success is not nearly as high as selling a put spread. But ultimately, buying the 114, 117 in the money call spread gets us long for $1.75. What's interesting is the 114 calls are currently in the money by $1.70. This entire trade only cost you $1.76, so there's very little extrinsic premium that you're paying for in here. What I'm basically saying is you're getting yourself, by buying the 114, 117 spread, listen, the maximum profitability in this trade isn't huge. It's only $1.25 to risk $1.76. But this is effectively the same thing as getting long shares of stock. Okay, this is a synthetic long position. Again, buying the 114, 117 spread for $1.76 gets you equivalent to long stock, but the maximum sustainable risk is $1.76 in here. If you went out and just bought the stock, obviously you have considerable more risk than $1.76. So that's something you can also consider is getting long, the call spread in there. We can go on and on. One thing that, we haven't mentioned is some people say, why don't I just go out and buy a call? If you go out, for instance, right now and bought the 120 calls, the 120 calls are trading for $2.71. If you buy those 120 calls for $2.70, what do you have? Well, you got a lot of risk in this position, don't you? Okay, so think about this. If I bought the 120 calls for $2.71, first thing that's going to happen is you look at your break-even point. Your break-even point is the strike plus the debit, which is obviously 122.71. Okay, so you're going to need a rally all the way about 123 to really make this worthwhile. The problem is if the market rallies up, inherently volatility will drop off and it'll crush a lot of the premium in these long calls. So one of the things I really kind of warn away from is in a market like this with a high volatility situation, you have got to be careful about buying calls looking for a bounce or a rally. If you're a person that you know that you need to go out and buy calls, look to calls that are deep in the money. Look to calls that are deep in the money because deep in the money calls have very little sensitivity to changes in implied volatility. It's a consideration. So to protect yourself from a high volatility situation, you need to, number one, look to deep in the money calls. Number two, and this should be your first thing, is look to utilize some type of vertical spread, okay, or some type of spread to mitigate the risk of the 40 volatility. All right, and that should be a big consideration. You have to understand that volatility is not only high in the S&Ps right now. Volatility is high in gold. It's high in bonds. Okay, we're inflated throughout the marketplace. The markets are pretty much on guard at this point. Everybody is a little bit nervous. It's going to be a wild ride. And I'll tell you, don't look for us to sit still here with the market down 18 today. Okay, don't think that we're going to stay down 18. When you have a VIX trading above 40, you have to expect considerable movement, and you can get some late-day moves here that are really wild and inverse moves throughout the trading day. Anyway, with that, we'll kind of wrap up here in the next few moments. And you guys, you missed your call-in chance. Anyway, with that, S&Ps are down 1750 right now. NASDAQ down 31. Dow down 185. Again, the VIX is sustained. It's up move here, up $4.17. Obviously, bonds are almost flat on the day. That's bonds and notes are almost flat on the day. Gold now is almost flat on the day as well. So we've seen some big reversals throughout the trading day. Even with these big reversals, though, we see oil off about $2. And again, that VIX being up, that's anybody's best guess at this point as to where we will close the day. This market, it's interesting with the VIX up like this. And the S&P is down. This market could close up 100 as well as down 100 on the Dow today. Quite easily, you can see a considerable rally, considerable sell-off coming into the close today. Anyway, with that, as always, I'll be back next week at 12 noon Eastern Standard Time, talk a little bit more. Thanks for joining me. I'm Don Kaufman with the Options Hour, and see everybody next week. Thanks a lot. Bye-bye.
Great Basin Gold is a mining company engaged in the exploration and development of two emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the fourth quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York Stock Exchanges under the symbol GBG.